One of the biggest lies that banks tell us is that our money grows in our bank accounts. The truth is, while the money increases in quantity due to interest, it doesn't increase in real value, especially with inflation rising and bank interest rates lagging behind. Keeping money in the bank is like poking a hole in your wallet. In this video, Robert Kiyosaki, an entrepreneur and billionaire, will give tips on 6 assets that can prevent this erosion of wealth and help you create intergenerational wealth: gold, silver, and platinum. One of the main reasons money is considered valuable is because it is used to store value for the future. However, governments are currently printing more and more money to finance their deficits. This means that you never know when that piece of paper you call a dollar will become worthless. That's why financial advisors invest in something valuable that is scarce and cannot be easily replicated. Before the 1950s, an ounce of gold could be purchased for $400. In 2023, the same ounce is valued at over $2,000. According to Prime XBT Gold Analysis, this value is expected to reach $10,000 in 2032. This means that, in about 10 years, your gold investments could be worth 5 times what they are worth today. So while money is losing value, gold continues to appreciate. In addition, other precious metals are also better options than keeping money in the bank. If you're wondering how to gain exposure to gold in your portfolio without buying the physical metal, you can invest in gold ETFs. Gold ETFs are highly liquid investment vehicles that offer returns based on gold price movements without the need to own the physical metal. In addition to scarcity, another reason precious metals are considered valuable is their natural utility value, which makes them indispensable for various industrial applications. For example, gold is used in the manufacture of electronic equipment, medical devices, and nuclear reactors, among others. Similarly, metals like cobalt, nickel, and copper are in high demand in industry due to their natural properties, which cannot be easily replaced by others. Since 2020, the demand for cobalt has increased significantly, mainly due to its essential use in the manufacturing of batteries for electric vehicles. As a result, cobalt prices have risen from $20,000 per ton in 2012 to $40,000 in 2022, a 100% increase in just 10 years. Therefore, having exposure to rare metals like these can significantly increase the value of your portfolio in times of high demand. However, not everyone can invest large sums of money to acquire precious metals, nor do they have the ability to store them physically or find reliable buyers. Therefore, investing in mining companies like Rio Tinto, mining-focused mutual funds, or even derivatives like futures and options are all excellent ways to gain this exposure. Safe haven. Currencies. In today's world of fiat currencies, where no currency is backed by gold, geopolitical stability plays a crucial role when investing. This is why the wealthy often keep their money in Swiss accounts. Switzerland, which has one of the strongest economic systems in the world, offers a more stable geopolitical environment. Therefore, the Swiss franc is considered a safe asset in times of turbulence and instability. We have seen this happen on several occasions, for example, during the Eurozone debt crisis in 2009 and the global financial crisis in 2008. Large funds transferred their assets to Switzerland to avoid losing value due to currency depreciation. Additionally, the Swiss franc is a valuable alternative to the US dollar for international trade. For example, during the crisis between Ukraine and Russia, when the US imposed sanctions on the Russian energy sector, Russia conducted its transactions in Swiss francs. These events affected the demand for the Swiss franc, leading to a significant appreciation of the currency against all other currencies. In 2023, 1 Swiss franc was quoted at 1,174, which led Swiss franc holders to multiply their wealth overnight. Therefore, high-value currencies like the Swiss franc, the British pound sterling, and the Chinese yuan are excellent assets. However, since not everyone can open Swiss bank accounts, there are currency ETFs and forex brokers. Have you ever stopped to think much about the dollar? This currency is, in fact, a legal tender for all public and private debts. Ever wondered what that means? Since 1971, when President Nixon abolished the gold standard, the dollar has become the legal tender. As per the EA law, this made it valuable as a medium of exchange, and we started considering it as a common form of payment for goods and services. Although no fiat currency in the world is backed by gold or any other physical asset, they are still considered valid because of the trust and credit of the government. In simple terms, the value of your money is as stable as the government that issues it, which is why investing in sovereign bonds is a legitimate way to preserve value. The governments of all nations are the last to go bankrupt. If a government collapses, the entire nation collapses, and no strong government will allow that. Therefore, one of the safest ways to invest in sovereign bonds is through government bonds, or GSX. However, only GSX from stable governments with investment-grade credit ratings are recommended. Remember the sovereign debt crisis in Greece in 2009. The International Monetary Fund, IMF, the Eurogroup, and the European Central Bank, ECB, had to renegotiate the country's debts several times. Therefore, the overall strength of a government should always be considered when investing in GSX. In the United States, you can invest in T-bills, notes, and bonds to gain exposure to sovereign bonds. They offer better returns than keeping money in the bank. Furthermore, these bonds are backed by the economic strength of the U.S. government on the global stage. Smaller investors can buy GSR bonds directly from the government through the GSS direct purchase portal or on the secondary market. Value stocks and mutual funds certainly offer a better return than keeping money idle. However, due to the low risk, they also provide lower returns than equity investments. And while low risk is an important criterion for risk-averse investors, most seek higher returns. Furthermore, not all stocks are equally risky. In fact, the investment market is divided into two types of stocks: value stocks and growth stocks. Growth stocks, such as those in the technology sector, are riskier due to innovative ideas and technologies that have a high potential for failure. However, value stocks, such as those of companies linked to industrial metals, are less risky due to the established demand for their products for the foreseeable future. Therefore, value stocks with solid fundamentals not only offer stable price appreciation, but also provide regular dividends. However, analyzing the fundamentals of each value stock can be time-consuming and risky for average investors. Therefore, mutual funds focused on value stocks, such as the Vanguard Admiral Shares High Quality Income Index Fund, with a history of paying solid dividends, are ideal and accessible investment vehicles for ordinary investors. Land and real estate. Banks consider land as a non-depreciable asset for a very solid reason. It is scarce and always in demand. Since the beginning of time, land has been one of the most valuable resources in the world. For example, we need land to build houses, schools, factories, for agriculture, and for commercial spaces, among other uses. As the human population grows, it demands more and more land. So homes, workspaces, and commercial properties built on land are always in high demand. Both land and the real estate market act as excellent hedges against inflation in your investment portfolio. To illustrate with some numbers, according to a Bloomberg study, house prices tripled between 1992 and 2020, despite a large drop during the 2008 housing crisis. Therefore, having exposure to the real estate market is always a good strategy when the dollar starts to lose value. However, most smaller investors usually consider investing in real estate much later in their lives, as they tend to associate real estate properties solely with the house they live in. However, having a fully paid-off house is a net worth goal that many strive to achieve in their 40s. But it is also recommended to have a share of the commercial real estate market. Also, contrary to popular belief, you don't need to have a lot of money to gain exposure to the real estate market. It is possible to invest in REITs, real estate investment trusts, or real estate investment funds, which are similar to mutual funds, but focused on the real estate market. Or you can purchase properties for income generation. The income generated will take care of expenses and mortgage payments, as well as provide collectible profits. Classic cars, rare artwork, luxury handbags, limited edition glasses, and even first editions of iconic books are part of this asset class. In the case of a regular car, its value will depreciate as soon as you drive it off the lot. However, the logic reverses when it comes to classic cars. Just like wine, they become more valuable with time. For example, according to Autocar, a 1955 Mercedes-Benz 300 SLR, known as the Gwyn Cop, was sold for 135 million euros in 2022. Only 2 units of this car were ever produced, making it a rare collector's item for automobile enthusiasts. Similarly, in 2017, Leonardo da Vinci's most controversial painting, Salvator Mundi, was sold at a Christie's auction for a staggering $450 million to a collector. The reason why the wealthiest invest substantial amounts in limited edition products is that these unique pieces are unpredictable stores of value. They can fetch unimaginable prices if you find the right buyer. Money in the bank makes you poor. We've all heard the expression that money in the bank is like a money tree in the garden. While there is some truth to this expression, it doesn't give us the full picture. Keeping money in a bank account is certainly better than keeping it hidden under the mattress. The main reason to keep money in the bank is that the bank pays interest on it. So common sense tells us that our money in the bank will grow due to this interest. But this doesn't happen in reality. To understand why, we need to understand the concept of purchasing power parity. In 1990, a McDonald's Big Mac cost about $3. Today, the same Big Mac costs $8. That's almost double the price. So the value of $3 when it comes to Big Macs has decreased considerably. This is due to rising prices, which we call inflation. Let's assume the inflation rate is about 4% to 5%. The interest rate on your bank account should be at least equal to this rate so that you can buy the same things you bought 10 years ago with the same amount of money. However, this is not true. Gasoline, milk, and practically everything else is more expensive. You must have noticed all the expenses that have increased in the last 10 years just to maintain your standard of living. This proves that the money in the bank account is not growing at the same rate as inflation. In fact, bank accounts usually offer an interest rate of about 3%. However, if we do the math, we are actually getting a negative interest rate of 1% since inflation is at 4%. So leaving money sitting in the bank account is not a good idea if you want to maintain your current standard of living. Instead, investing in assets that grow more than inflation is a great way to preserve your wealth. Some great options can be businesses, real estate, and even precious metals. If you prefer safer investments, we always check our bank accounts, right? Yes, we tend to check our bank accounts regularly. This gives us peace of mind that no matter what happens, we'll at least have the same amount as our bank statement shows. However, this is not always true. Your bank may not always allow you to withdraw all the money from your account. The reason for this is known as the fractional reserve system. In this system, every bank is allowed to loan out all the funds they have in their accounts, after setting aside a fraction of it as reserves. The reserve ratio is determined by the central bank of the country, which in the US is the Federal Reserve. After reserving the required amount, banks lend out the rest at a rate higher than what they pay you. The difference between the lending rate and the deposit rate is their profit. Let's crunch some numbers. Suppose you deposit $1,000 in your account. The reserve ratio is 10%. This means the bank can lend out 90% of your $1,000 to borrowers. But the story doesn't end here. When your bank lends someone $900, that amount is deposited in the borrower's bank account. This second bank, in turn, reserves 10% and lends out 90% to another person who receives $810, and this cycle continues. Have you ever wondered how much money is created from your $1,000 when the reserve ratio is 10%? The answer lies in the mathematics of infinite geometric progression. In simple terms, the total amount of money generated from your $1,000 equals 1,000 divided by 0.10, which is 10,000. Yes, this money is created practically out of thin air. You may be wondering why banks can do this. The answer is simple. Banks operate on the premise that not all depositors will try to withdraw all their money at the same time. Because of this rather basic but true premise, banks are able to maintain their liquidity without collapsing. They still allow depositors to withdraw the money and at the same time generate profits from it. However, you can imagine what would happen if all depositors tried to withdraw all their money at the same time. The world economy may collapse due to the bankruptcy of banks. A real example of this was the financial crisis of 2008, when depositors panicked and rushed to withdraw their money. Due to a large number of withdrawal requests, about 25 banks went bankrupt in the US in 2008. The same happened recently in 2023, when depositors of well-reputed banks made massive withdrawals of $10 billion. This mass withdrawal occurred as a result of the sudden collapse of Silicon Valley Bank, becoming the third largest bank failure in US history. Eventually, regulators had to step in and put the bank under their protection to restore financial stability and regain public confidence in the economy. Low risk means low return. While most middle-class people avoid taking risks when they don't have money, rich people invest even when they do have money. The most important reason why rich people invest is that the richer they are, the lower the tax rate they pay. The return on investment is what banks receive. While this may seem counterintuitive to middle-class people, it makes perfect sense to banks. Banks make money based on two factors: return and risk. While return is always an important factor for any business, including banks, risk is even more crucial when it comes to a bank loan is high. To compensate for this high risk, banks will offer a much higher interest rate. On the other hand, someone like Mark Zuckerberg can get the same interest rate for a much smaller amount. Naturally, the risk of Zuckerberg defaulting is practically nil compared to the risk of any middle-class American defaulting. This is exactly what happened when Zuckerberg applied for a loan to buy a house in 2012. Although the interest rate was 2.69%, Zuckerberg received a rate of only 1.05%. This resulted in a difference of 2.69 minus 1.05, or 1.64%. Although a difference of 1.64 may not seem like much in percentage terms, in financial terms it represents a considerable difference. Zuckerberg paid $5.95 million, so a difference of 1.64% meant $9,160 less in interest for Zuckerberg. This represents almost $1,000 less each year on his 30-year home loan. This is equivalent to saying that his loan was $3 million cheaper, even without taking into account the effect of compound interest. Debt is free money for the rich. Another reason why the rich invest even when they have enough money is because debt offers other benefits. Continuing with the story of Zuckerberg's loan, we can see how he used debt to his advantage. As we all know, Zuckerberg, with a net worth of $15.7 billion at the time, didn't really need the loan, but he did it anyway. The hidden truth behind this was that he knew that by simply putting that money into an index fund with an 8% return, he would earn about 7% interest, a much higher return than the 1.05% rate he owed the bank. In addition, by using this loan to pay off debts, Zuckerberg saved even more money by paying lower rates. So, if you're as savvy as Zuckerberg about your debt, you can easily turn your debt into free money. Credit cards are a trap for banks. If you think bank representatives are on your side, you are very wrong. When bank sales representatives try to sell you a credit card or any other product, they don't take your best interests into account. They're just worried about hitting their monthly targets. And if they're being overly friendly, you should take that as a big red flag. Credit cards are a big trap for banks, but at the same time, they are also a trap for you. There are several reasons for this. The first and most obvious is that, like any other debt product, credit cards have one of the highest possible interest rates, which can be as high as 20% in some cases. If you shop responsibly and pay off your debt on time, then this shouldn't be a problem. However, few cardholders fit into this category. A survey by LendingTree showed that, as of 2020, Americans had a mountain of credit card debt in front of them, totaling $986 billion, and of the total number of credit card holders, 65% do not pay off the full balance each month. The biggest problem with credit cards is that they can disconnect you from the act of paying for your purchases immediately. This creates an illusion of free spending, and people start spending without considering how they will pay off their debts. And this is how the debt spiral begins. The second, more subtle problem with credit cards is the processing fee. This does not refer to the annual fee charged by the bank. Rather, it is an extra fee that you pay with each purchase. Banks pay this fee to merchants and stores every time a customer makes a payment with a credit card. This can be up to 15%. If merchants absorb this cost, many of them will lose money. So they pass this cost on to customers, who end up paying the processing fee. And that is reflected in the value of your purchases. This happens because the processing fee is paid by the merchant, and in turn the market passes this cost on to the customer. Thus, the processing fee impacts the value of your purchases. Therefore, it is a personal choice to decide whether you want to continue using credit cards or not. If you found this video helpful, please like and subscribe to the channel. See you in the next video.